Hi everyone, this is Craig, the options linebacker. This is the weekend report for Sunday, January 16th. The chart I'm going to start out with today is the S&P 500, and this is log scale, and this is pretty much the modern history of the S&P 500. We start with the initial crash that we had back in the Great Depression, and then we can see from there that it went sideways after that from the late 30s until almost 1950 before it finally broke out, and then we had a strong trend from about 1950 until we got into the early 70s, and again a heavy sideways period, and then a strong trend, and then until we got to about the year 2000, and then another sideways period that we're in right now. So about every 17 to 20 years we're running into these major sideways periods, and they can go for quite some time, as we can see by these blue boxes. So like it or not, this is what we're stuck in right now, and until this range is broken, buy and hold is actually probably a very poor strategy until we actually break outside of this range and perhaps even retest it from above. From here, let's do a quick top-down analysis. We'll start with a monthly chart of the S&P 500. We can see that during this time frame we've had a couple cyclical bear markets from 2000 to about 2003, and then obviously the 2007 through early 2009 bear market. And we've had a couple of very strong bull markets during that time. The first one from 2003 to 2007. And yes, believe it or not, we are in a bull market right now. That was confirmed late last year when this prior swing high was taken out. So we're definitely in a bull swing right now, and we have been for almost 2 years, even though it doesn't feel like one. And that's the big problem with most traders, is that it doesn't feel like one. As you look around, you read the news, you see the unemployment numbers, it does not feel like a bull market. Far from it. The market doesn't care about those things though. The problem that we have as human beings is that we remember this all too recently and are kind of still affected by that. It's like an anchor around our legs. This is exactly why retail money always gets in at the very end of a trend. Retail money really didn't get involved until the 2006-2007 timeframe, as they bought right in at the top because all of a sudden they felt comfortable with the market. Okay, if we've established that we're going up right now, we see the wave count 1 up, wave count 2 down. This was just a corrective pattern, as we'll see in a minute. And then we're currently working on wave 3 up, and it's turning out to be a good powerful wave, which it needs to be as wave 3 on the monthly chart. Now if we zoom in, we can start to see a lot more detail. Again, what we've seen so far in this bull market since the bottom in March of 2009 has been the initial wave up was about 289 points. We had a small corrective wave into the summer. Then the third wave up was about 281 points. Normally I'd like to see the third wave a little bit longer, or the longest of the three. However, as stretched as we were to the downside, it's not surprising that we had a very strong first wave. So that third wave was about 281 points, and then the fifth wave, as we should expect, was a little bit smaller. That exhaustion wave is about 176 points. From there, what we saw into last summer was almost a textbook corrective wave, an ABC wave coming back down to a 38.2% retracement of this entire move. I'm telling you guys, it just does not get any cleaner than that. However, what we're all going to agree on was this summer's correction made it feel, and that's the operative word here, feel like we were heading straight back down to S&P 600. And that's exactly what is required for a correction to do its job, because as we got to the point here where we put in a higher low in late August, the level of bearishness was almost exactly the same amount as what we felt right back in this area during the heights of the crash back in the fall of 2008. And everybody was carrying around the anchor in their back pocket of how badly it felt back through the crash of the financial disaster in fall of 2008. And this is where too many people had too large of a bearish position and were on the wrong side of the trade, and what we're still seeing is that being unwound to the upside. Again, guys, forget about the fundamentals, forget about what the Fed is doing. We can all come up with our stories of why the market's doing what it's doing, but price is king, and price is going up right now. So what we've had since then, since July 1st, has been the first wave to the upside. That formed a double top. I think that also helped create that illusion of that failure point there in late August. But what we've seen now is this has all been one wave 3, and this is 253 points to the upside now. I was wrong in my initial wave count. I thought this was going to be a weekly wave lower. I thought this was going to be wave 4 lower. This is all one big wave, and it's on par with one of these waves now. So if we expect that this one's going to play out to around 280, 290 points, then we could probably find the top of this swing up at around 1320 or so before this one will finally exhaust itself. And we do have overhead resistance right up in that area, so that may be a good time for people to take profits. Now, if that does lead to another intermediate correction, perhaps around 80 to 100 points, we could fall back to around the 1260 area sometime through the middle part of this year, perhaps the spring. And then if we see another 180 point move, well, then we're back up to our initial target of this at about 1400. Now, that initial target is really based on this entire cup and handle. So there's the cup, there's the handle. This is classic, folks. And this should get us to right around this area, which is coincidentally what I'm hearing a lot of other people call for this year, is somewhere up around 1400. And as you can see, we have some good overhead resistance in this level. Now, what we're not accounting for is an even larger fractal time frame where we have yet another cup and handle pattern, which is this one right there. So there's the cup, there's the handle, and we're breaking out of that right now. So this is obviously pointing at new highs, and that probably will not happen through this year. We're probably talking about something next year. To be honest, that's too far out. I'm not going to focus on that right now, but I am looking at the fractal time frames and the patterns that are showing up right now, showing that we may be discounting what could be on the horizon for us. As we get down to the daily chart, we zoom in here, we do have the price outside the Bollinger Bands, and like boxers in a boxing ring, anytime they get pushed outside of the ropes, they tend to jump right back in again. And so this is what we'll probably expect to see within the next couple of days. Later on this week is that we'll probably see the price get back inside the bands as a result of one of two things happening. Either the bands expanding up to accommodate the additional volatility, or the price actually pulling back, getting a little too far ahead of itself. We can see that every time this has happened in the past, those two things will happen. The price will accommodate and the bands will expand. As we go in one more level to the 60-minute chart, we can see that actually the price has been within this very defined channel for quite some time, the better part of 6 weeks or so, really, since the 1st of December. It's been in this channel. You can see that the price is just starting to pop outside this channel, which can happen. A lot of times when people chase the move, you'll see the pop above the channel, but eventually they'll get pulled back inside here again. Now, for a different view of the S&P, this is the daily chart again. What we're going to look for is the penetration of these pivots, 1278, 1261, 1247, or 1227, to let us know that there's an early warning shot over the bow that the trend may be changing. So the first thing that would happen here is that we'd have a lower low, which is going to fall below one of these pivots, and then at some point we're going to have a lower high. And that's where we might be moving into that corrective pattern that we talked about on the weekly chart. In the meantime, we do have an expiration day coming up this Friday. We have just about zero at risk at this point. And in fact, what we've been able to do is one of the defensive trades that we have, which is this butterfly. The price is right inside the center of the butterfly near expiration. So we're going to be able to take that off on Tuesday for a very nice profit. Now, this is an entirely defensive trade. It's not an offensive trade that I place the expectation of making a profit, but this is almost like the football analogy of having one of your safeties run back an interception for a touchdown. It's kind of a bonus, having a defensive trade actually score a nice profit for you. Enjoy the day off tomorrow. We'll catch you next week, folks. Take care.